Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinnii Motiwala, and thank you so much for tuning in as always. Now, with the rising education costs, it is very important, not just important, very important for parents to plan ahead for their children's future. Investing in child's education plan is one of the options and one of the ways to build a dedicated fund for their future needs. But how is it different from investing maybe in mutual funds through SIPs or lump sum way? And under what circumstances can you see that, maybe a child's, education insurance plan would be more beneficial than mutual funds? Is that the case? We'll try to get all those answers, and to answer all of that, we have Varun Fatehpuria, founder and CEO at Daulat Finvest, joining in with us. Varun, good afternoon, and thank you so much for joining in with us. Now, other than inflation that we look at, children's education inflation is much higher in terms of fees that they have to pay, the classes they have to go for. Everything comes out to be much higher for a parent. Let's just start by talking about the main difference that is there between investing in a child's education insurance plan versus maybe something like in a mutual fund or going through the SIP route. What is the main difference here?
Hi, Vinnii. Firstly, thank you for having me back on the show. As you correctly pointed out, the education inflation, not just in our country, but globally as well, significantly beats the general inflation of 5 to 6%, right? So as you rightly mentioned, yes, I think it is important for parents to look at this number and start planning as early as possible so that they're able to meet their financial goals with respect to, their child's education in a more smooth manner. And with respect to the options today that are available, yes, on one hand, we have the child insurance plan, and within child insurance and as well, there are a couple of options which parents could look at. One is the child insurance savings plan, which combines the component of both insurance and savings, right, where a certain percentage of your premium is allocated towards providing a life cover for the proposer or the parent itself. So in the event of an untimely demise of the parent, the child gets a lump sum payout at that point in time. And then the second component is the savings component, which gives them anywhere between 5 to 6% if we actually run the numbers. But this is guaranteed return, which the child will get as a lump sum during the maturity of the plan itself. Okay. And then the other component of the child insurance plan is one where it combines a ULIP policy, where along with providing a life cover, it also invests in market-linked instruments. So think of equity, debt, gold in the market to provide you with higher long-term wealth creation opportunities. Right. So that's on the child insurance plan.
Obviously, I just want to understand a bit more, because how flexible is it, versus mutual funds, which you can, anytime withdraw it as well. It's higher returns as well. Now, in these child education insurance plans or any specific plans for that, what is the flexibility? What is the withdrawal? How is the investment amount if you want to make any changes, increasing? What is the whole process for that as well?
So definitely, Vinnii, if we compare it with, let's say, mutual funds, on the other hand, the kind of rigidity that the child insurance plan typically offers with respect to, let's say, investments and also withdrawals, but also, let's say, with respect to changing your investment objectives over a period of time. So there are very limited avenues. Once you have basically put in your premium into these kind of policies, for all effects and purposes, you are effectively locked in for the next 10 years, 15 years. Yes, there are options in the forms of riders, which insurance companies provide you, where you could have partial withdrawals, increase your premium amount, whether monthly, quarterly, half annually, right? But it significantly sort of compared to a mutual fund option on a transparency basis, on a liquidity and flexibility basis, comes in handily lower.
Mm-hmm. Varun, are there any scenarios? Firstly, actually, let's just talk about returns that are there for both. In mutual funds, obviously, what is the average return that one could expect? And if someone is holding it for a longer period of time, since we're talking about child education, they start maybe when the kid is small, they're holding it for 10 years as well. So one is mutual fund return on that terms, as well as the child education insurance plans. What are the returns over there that you see? How is it comparable?
So let's say if you look at it from a mutual fund perspective, since most of the mutual funds today, if you have a longer term horizon, you would in all likelihood be investing in a 100% equity portfolio,
Yeah.
right? Which invests in a combination of, let's say, large cap, mid cap, small cap. You really have the flexibility over there depending on, what your risk appetite is, what your investment objective is, to craft and customize your portfolio basis your need. So if I were to look at the last 10 years, 15 years data, a combination of large, mid, and small in the range of 50, 25, 25 could have easily earned anywhere between 14 to 15% CAGR for you, right? So that is on the mutual fund side, assuming your portfolio construction is done correctly. But let's say if I come to the insurance side of things, obviously the guaranteed savings plan offers you from a return perspective anywhere between 5 to 6, 6.5%, because it is a guaranteed product, right? So you are assured that you're going to receive that kind of a sum at the time of the maturity. But if I look at, let's say, the ULIP options, definitely the return is slightly higher in the range of 11%, because those invest in market-linked instruments.
Absolutely. Varun, then, just looking at the return point of view, it always looks attractive when you're just looking into mutual funds. Are there any specific scenarios that, one should look at a child education insurance plan versus a mutual fund, or vice versa? In which scenario, what would be more suitable?
So I think, Vinnii, for parents who, let's say, have limited resources to understand about the markets and do not want to get into the nitty-gritty of, where they should be investing, right? For people seeking a assured, guaranteed rate of return on their product, for them, we feel that a child insurance plan comes in very, very handy, that they put in a certain amount of money at a particular given point in time, and they're assured that this sum of money will come to fruition by the time my child enters college or whatever the interim goal is in between. So that is really one of the benefits, or perhaps the only benefit that I could think of, right, in terms of a child insurance plan per se, where it handily beats a mutual fund. But obviously, over a period of time, let's say one really needs to stay invested for a longer period of time, 10 years, 15 years, 18 years down the line, right? Even investing in a simple index tracking a Nifty 50 or a Nifty 500 could give you a significantly higher rate of return than what a guaranteed rate of product could give you. But obviously, there is no assurance that you would be able to achieve that kind of return, since it is investing in the markets.
Absolutely, Varun. How should one actually invest in mutual funds? Because we have a specific goal, or, that is decided that you want to use it for your child's education. Then would SIP make sense, or would investing lump sum at such a time would make sense with the discipline of maybe holding it for the time period they want, or 5 years, 10 years, or whatever it is? What is the better way in such a situation?
So I would say a combination of both would come in handy. I think it is important that parents fix in a certain amount of monthly contribution amount that they want to invest in mutual funds through SIP over a longer period of time, because it instills a certain level of discipline and allows them to average down their costs down due to the volatility of the equity markets, right? So that is where SIP comes in really, really handy. It allows you to be disciplined and save a certain amount of sum towards your education goal. And as and when once you have a lump sum in the form of any liquidity event, whether that's in the form of a bonus or a payout somewhere, depending on the market conditions, you could always top that amount up to provide you a kicker in the form of a returns when when we are in a bull market, when we are in a bear market, or the markets are trending down for a longer period of time. So look for a combination of both SIPs and lump sum, but definitely start with SIP, because your burden also typically tends to lessen if you're investing smaller sums of money over a period of time.
Absolutely. Varun, there may be parents who may have not started earlier on in the days to start investing for their child's education plan. What is the advisable way to start in terms for either SIP? Should they consider a children's, education insurance plan instead? And is there a lock-in also for these education insurance plans that come in? So how should they move about now?
So obviously, Vinnii, I think if parents have not started planning for their child's education early on, depending on the kind of education inflation that we talked about, the burden in the latter half of the years could be significantly higher. So I think the only option is, I think if you have not started and if your child is about to enter college in the next 5 to 6 years, right, then if you're investing, let's say, in a child insurance plan, that would definitely require a higher amount of outlay because the return assumptions over here would be, let's say, 5 to 6%. And most of these plans also come with a certain amount of lock-in that could range anywhere between 5 to 7 years. Albeit some will provide you that partial withdrawal benefit, but the percentage of that would be significantly lower. So if you're considering investing in an insurance plan with that kind of a return assumption, then obviously your outlay for a 4 year, 5 year goal would be higher. But let's say if I want to switch gears and talk about investing in mutual funds through SIPs as well, obviously the contribution there would be higher as well, vis-a-vis if you would have started 5, 7 years back. And now assuming that you have only the next 4 to 5 years to achieve this goal, then 100% equity allocation would probably not be advisable. You would probably have to look for a more balanced portfolio, let's say somewhere like a 60-40 allocation to equities and debt, so that your capital is also protected over a shorter period of time, but you get to participate in the growth of the equities. So this is how I would like to advise parents to think. If you're thinking about insurance, obviously it's a guaranteed payout, but the outlay is higher. If you're thinking about mutual funds SIP, the outlay would be relatively lower compared to mutual funds, but you would have to moderate your return expectations as well.
Okay. Varun, what are the most common mistakes that you've seen which parents make while choosing between options for their child's education, and something that they should for sure avoid in such a scenario?
I think one of the biggest mistakes we see, or rather points which parents tend to overlook when calculating the amount of money that they would require for the child's education, is the inflation number itself, right? If we assume a standard inflation in a country of 5%, but if the education inflation is significantly higher, as high as 9 to 10% as well, right? So it's always better that we assume for a higher number and then contribute an amount towards that rather than settling for a lower amount, because there could be a scenario where the number could be higher, right? So take into account the education inflation at the higher end so that you have a higher purpose that you're working towards. Secondly, for parents who are planning to send their child abroad, whether that's Singapore, US, UK, or any of the countries abroad, take into account the currency depreciation. Again, this is something that we see that parents do not take into account, because that adds to the cost as well, right? If we assume a standard depreciation of INR against a basket of currencies, this could be anywhere between 4 to 5%. So that on top of the education inflation, just from a nominal perspective, you're looking at 10 to 12% that you need to take into account, at which the cost will continue to run up over a period of time.
Okay.
And finally, just not locking yourself into too rigid structures, because sometimes if you need a partial withdrawal in the middle of that goal, then it is important that you are not paying any sort of a penalty or withdrawal charges to withdraw that money in the interim. So think about 2 to 3 these points, which definitely should not be overlooked.
Okay, absolutely, Varun. Varun, just to follow up in terms of then the best would be a mix between insurance plan and a mutual fund if, they have that band space, and what should be the division there? Also, is there a tax component that comes into play for both these different mutual funds? Obviously, will be taxed at long-term capital gain, but for child insurance plans, is there education plans? Are there different taxations?
So let's say if I'm talking just from a taxation purely perspective, for people in the old tax regime, they could utilize the contribution if they're investing in any sort of an insurance policy, whether that is a child insurance policy, deductions up to 1.5 lakh rupees under Section 80C of the Income Tax Act, right? So every year you could probably have that amount deducted from your gross salary in terms of the deductions itself, right? If I'm looking at it from a mutual fund perspective, yes, there are child mutual fund plans as well, which comes in with a lock-in of 5 years and gives you that same taxation advantage of 1.5 lakh rupees deduction under Section 80C of the Income Tax Act. The redemptions itself would be taxed at capital gains, so there are no particular benefits over there, right? The long-term capital gains will come at about 12.5% after 12 months. So that's what people need to know about from a taxation perspective. Our advice always is that keep investment and insurance separate, right? The goal that you're achieving through a child insurance plan is providing for that lump sum or the maturity benefit in the untimely demise of the
Right.
policyholder. So get a separate term plan for yourself, and then the remainder money you could easily, just park it into a mutual fund, whether
Sure.
through SIPs or lump sum.
Okay, thank you so much for that, Varun. But Varun, do stay on with us. We have ended this topic, but after the break, we're going to be discussing how RBI's rate cut will impact mutual funds, what should you all be looking at, how you should be reallocating and rebalancing your portfolio. All of that after the short break. Welcome back to MF Corner on CNBC TV 18. Now let's talk about the latest decision that was made by the Reserve Bank of India, and they slashed the repo rate by 50 basis points to 5.5% and cut the CRR ratio, that's the cash reserve ratio, by a full percentage point. This is a move that is likely to reshape the outlook of the debt mutual fund investors. We've spoken about how this actually, benefits debt mutual funds as well. To discuss more on this topic, how you should be looking at rebalancing now, given that it's a 50 basis point that a cut came in this time, we still have with us Varun Fatehpuria, CEO and founder at Daulat Finvest. Varun, this decision that came in on Friday, that was something that we were expecting over a period of time, and next few decisions that we were expecting to come in. But this is coming sooner than expected. Fixed deposit rates are expected to come down further. Debt mutual funds obviously will see some bit of a benefit coming in. How should investors be looking at this? And do FDs now just become redundant and you should just look at debt mutual funds?
No, absolutely, Vinnii. I think one of the biggest now potential risks that a lot of the fixed income investors, whether they're investing into FDs or debt mutual fund, is the reinvestment risk as their fixed deposits start to mature in the next 3 to 6 months, and they'll be faced with this conundrum that how to invest in a low interest rate environment, right? Just to give you some numbers, 1 year back, most of the fixed deposits were yielding anywhere between 7% to 7.1% for a 12-month tenure. And debt mutual funds also tended to offer a similar amount of return, at least on the shorter end of the curve, right? Now, as the RBI started to ease the monetary policy and went in for a policy repo rate cut, they have had about 100 basis points of rate cut since the start of this year to about 5.5%, as you mentioned. So debt mutual funds have started to definitely benefit, starting with debt mutual funds on the longer end of the curve. So if you see the returns of longer duration funds over the last 1 year, it has anywhere been between 12 to 13%. But obviously, I think once we start to have a more stable monetary policy and the repo rate starts to stabilize a bit, right, then the next 3 to 6 months onwards, you will see a corresponding impact on the debt mutual funds as well, where the returns will start to come down in the range of, again, 6.5%, depending on where the policy repo rate is. So yes, in the interim, in the next 2 to 3 months, it could be a good time to, let's say, play the capital gains, play duration, and maybe get additional 150 to 100 basis points of alpha compared to your other traditional fixed deposits. But over a period of time, we are assuming that would start to stabilize as well.
Okay. Varun, given that there's a change in stance also that has come in, how should one rebalance their strategies in terms of debt mutual fund portfolios? Also, are there any specific mutual funds or categories that are more resilient or more opportunistic in this current falling rate scenario that we've seen coming in?
So, Vinnii, I think investors need to firstly understand their objective of parking money into a debt mutual fund, right? If they're primarily parking it for, let's say, cash management purposes, moving money out of the savings account, which is now sub 3%, then definitely they will continue to gain about 6.5% in liquid funds, ultra short-term funds, money market funds. So for investors having, let's say, shorter duration investment objectives, anywhere between 3 to 12 months, right? There they will continue to benefit significantly by investing into debt mutual funds compared to, let's say, even shorter duration FDs or definitely a savings account at sub 3%, right? But people having, let's say, investment horizons longer than 12 months, let's say 18 to 24 months, they could start looking at short duration funds and medium duration funds, which start to play duration slightly more in a moderate manner compared to the longer duration portfolios that we talked about. And assuming that investors hold these portfolios to maturity, they can stand to gain the yield to maturity at the time of investment, plus any sort of a duration benefits if the interest rates start to decline further in the next 3 to 6 months. So that's how they should look at the debt mutual fund portfolios. From a alternative perspective, yes, there are categories that they could potentially also look at. There is a new category of funds called as income plus arbitrage, which stands to benefit from a taxation perspective. So on a 2-year basis, you get taxed at capital gains at 12.5% compared to tax slab for your debt mutual fund portfolios. So that's a potential option that they could look at as well.
Okay, thanks for that, Varun. And how might these rate-sensitive equity mutual fund sectors or sector-specific funds and thematic funds are there, especially financials, real estate, which are indirectly likely to benefit from these decisions? So how should investors adjust their equity mutual fund exposure also for these sectors then?
So definitely, I think what we saw on Friday, there was a big run-up in sectors which were perceived beneficiaries of the rate cut: financials, real estate stocks, public sector banks, or autos, right? So all of the linkages which come from, a decreased level of interest rate in the economy, because directly or indirectly, all of these sectors stand to benefit tremendously, whether in the form of a higher credit growth for financials or increased affordability for autos and home loans, which drive demand for these stocks as well. But our suggestion always has been that try and, bucket your portfolio into core and satellite. Core, where it will continue to remain your diversified equity mutual funds, so large cap, flexi cap, multi cap funds, which give you broader exposure, and keep your exposure to the sectoral thematic funds which you like, which stand to benefit, let's say, potentially in the next 12 to 18 months, right, to about 10 to 20% of your portfolio, because that is where the maximum error happens, where investors tend to go overboard, but they enter at the wrong time and then they're not able to exit it. So these are definitely the sectors which will stand to benefit, but again, try to keep a balance between your core and satellite allocation.
Sure, Varun, thank you so much, for giving us those insights over there on how they should balance their portfolio. And thank you so much for joining with us on the show as well today. With that, we're absolutely out of time on this edition of MF Corner on CNBC TV 18. Thank you so much for tuning in today. But don't go anywhere. Closing bell is up next to take you through the last hour of trade.